Hello everyone, and welcome to this webcast on the recently published discussion paper, Financial Instruments with Characteristics of Equity, or FICE for short. My name is Kumar Dasgupta, Technical Director at the ISB. In the next 10 minutes or so, I will take you through an overview of this discussion paper. But before we start, just a couple of housekeeping points. You can download the slide pack by clicking on the button below the slides window. Also, this webcast is not live, it's a recording, so we are not taking questions from the audience today. Finally, the views I'll be expressing are my own and not necessarily those of the board or of the IFRS Foundation. Okay, so this webcast will be the first in a series of webcasts exploring the FICE discussion paper. This webcast will provide you with a brief overview of the discussion paper, including the challenges identified and how the board is responding to them, the scope of the project, and how the preliminary views compare with IS32 and what is and what isn't changing. Future webcasts will delve in more detail on particular areas of interest, including an overview of the board's preferred approach and its application to non-derivative financial instruments, classification of derivatives on own equity applying the board's preferred approach, classification of compound instruments and redemption obligation arrangements, presentation of equity instruments, and presentation of financial liabilities. About the project. Before we talk about the board's preliminary views, we would like to give you some context about the project, its scope, and its possible effects. First of all, we wanted to discuss where this project sits in terms of the board's overall agenda and its due process. The FICE project is what we have called a research project. The primary aim of a research project is to explore a particular issue to help the board decide whether it should add a project to its agenda to replace or amend a standard. This involves identifying and defining the challenges, assessing whether the challenges merit the board taking action, and considering alternative approaches to addressing the challenges and their feasibility. The FICE project is exploring improvements to the information entities provide in their financial statements about instruments they have issued and improvements to address challenges with applying IS32 in practice. The board has published the FICE discussion paper to obtain feedback on the challenges it has identified and to test its preferred approach to addressing those challenges. The board will consider comments received on this discussion paper before deciding whether to develop an exposure draft with proposals to amend or replace parts of IS32 and or to develop non-mandatory guidance. Please note that the comment period for the discussion paper ends on 7 January 2019. Why is this project important? The distinction between liabilities and equity has an important role in financial reporting. It helps provide structure to the statement of financial position, and perhaps critically, it determines what changes in the claims against an entity are included in depicting an entity's financial performance, i.e., changes arising from which instruments are included in profit or loss. IS32 is the standard that determines the classification of financial liabilities and equity instruments. Given the consequences of the distinction, issues with IS32 can have a big impact on how an entity depicts its financial position and performance, consequently affecting an user's assessment of those aspects. The next thing we would like to talk about is the scope of the project. There are two aspects to the scope: what types of transactions we are looking at, and what accounting requirements for those transactions are we considering. The FICE project focuses on the classification of financial instruments from the perspective of the issuer as financial liabilities or equity instruments, which are currently dealt with by IS32. The FICE project also considers presentation and disclosure as additional means of communicating information about financial instruments an entity has issued. The FICE project does not address the recognition and measurement of financial instruments, in particular accounting for financial assets. Also, while a predecessor project was a joint project with the FASB, this project is not. In identifying the challenges, the board has listened to feedback received from the board's previous consultations, including the predecessor project, the agenda consultations, and the recent project on the conceptual framework. The board has also considered questions and concerns raised through other forums, such as issues raised through the Interpretations Committee. While IS32 has been working well, there is a growing set of financial instruments that have raised challenges for preparers applying IS32, and for users understanding the consequences of those instruments on an entity's financial position and performance. There has also been continuing debate about the underlying rationale of the distinction between liabilities and equity in IS32. In addition, there have been long-standing calls from investors, in particular equity investors, for better information about particular features of financial instruments, such as priority and potential dilution about equity instruments, given the lack of specific disclosure requirements. How an entity classifies financial instruments that it issues will affect how it depicts its financial position and performance, and the assessments users make of its financial position and performance. Example, through the use of totals and subtotals of liabilities and equity in various financial analysis, such as debt-equity ratio, etc. Therefore, those challenges with the distinction will make it difficult for investors to assess and compare companies' financial position and performance. The board's first step was to analyze the issues raised. Based on its analysis, the board identified a number of challenges. A fundamental challenge of making any distinction between liabilities and equity is the simple fact that a binary classification can only provide part of the information about the wide variety of claims against the entity. A number of application challenges also stem from a lack of clarity regarding the underlying rationale for the classification outcomes in IS32. This has resulted in some inconsistent requirements and questions about the application of IS32 to instruments that are not specifically addressed in the requirements. To respond to these challenges, the board has developed an approach that articulates principles for the classification of financial instruments as financial liabilities or equity instruments with a clear rationale, but without fundamentally changing the existing classification outcomes of IS32. Improves the information provided through presentation and disclosure about features of financial liabilities and equity instruments not captured by classification alone, and improves the consistency, completeness, and clarity of the requirements for classification, in particular for derivatives on an entity's own equity. Before we discuss the details of the board's preferred approach, we just wanted to touch briefly on the expected impact and what might and might not change. We have clearly heard that IS32 works well in most circumstances, and consequently the board is seeking to limit unnecessary changes to the classification outcomes. The classification for simple bonds, ordinary shares, and other simple instruments will not change. The board has tried to target the problem areas, but it has done so by seeking to make the principles for distinguishing financial liabilities from equity clearer and improving the presentation and disclosure requirements. This was preferred to adding more patches to IS32, since some of the patches made in the past have further exacerbated some of the challenges identified. Such an approach would help investors get richer and more comparable information about complex financial instruments issued by companies, and the clarified principles will help companies accounting for those complex instruments. It will also help companies apply the standard to new financial instruments in the future. By doing this work now, it will also make it easier to apply the standard to new financial instruments as they continue to evolve. In addition, we have also taken care not to change the accounting for the areas that we know IS32 works well, including the puttables exception and IFRS 2. In addition, we are mindful of making changes to IAS 32 that would have consequence beyond the classification of financial instruments. This slide summarizes the areas that have largely been carried forward from the existing requirements in IAS 32 unaltered. This slide sets out the structure of the discussion paper. The webcast series will touch on some particular areas of the discussion paper to help explain and illustrate some of the preliminary views, in particular for sections 4, 5, and 6. As I mentioned earlier, we plan to do a series of webcasts on the discussion paper. The next webcast in the series will provide an overview of the approach the board has developed to classification, presentation, and disclosure, and the application of that approach to the classification of some non-derivative financial instruments. I hope you will be joining us for the other webcasts as well. And thank you for listening to this webcast, and I hope you found it useful.